Thermo Fisher Scientific Inc. is an American multinational corporation operating in life sciences, healthcare, and the laboratory equipment industry. Thermo is renowned for its extensive range of products and services that support scientific research, drug discovery, diagnostics, and manufacturing processes worldwide.
Bio-Rad Laboratories, Inc. is an American multinational firm specializing in the life science research and clinical diagnostics. This company is renowned for its innovative products and solutions that contribute to advancement in healthcare and scientific research globally. Fun fact about Bio-Rad Laboratories, Inc. was founded in 1952 by husband and wife team David and Alice Schwartz. The company's name is a combination of their last names, bio representing biology and rad representing radiation, reflecting the couple's background in the medical research and technology field.
Okay, so talking about liquidity, that's an ability to be able to convert something into cash. So when we talk about our current ratio, we're talking about the ability to cover your short-term liabilities with your short-term assets. So throughout the time period, we saw that both companies, Thermo and Bio, had a bit of fluctuations, from that 2019 to 2023 range. And Bio-Rad had a significantly higher current ratio than Thermo throughout the entire period. But it's also important to note that while Bio-Rad did have a higher current ratio, Thermo's was still enough to be able to cover all of their liabilities, as you would hope, just for maybe like a 1.2 current ratio, and Thermo's still did exceed that. So they were still able to cover their current liabilities with their current assets. And so then when we jump into the quick ratio, it's going to be very similar, but it's being able to cover the current liabilities only with the most liquid assets. So that's going to be excluding inventory, because oftentimes that's the current asset that could take the longest to convert to cash. So with the quick ratio, we saw a little bit of variability, just like the current, and Bio's was also pretty significantly higher than. Okay, so then getting into our asset management ratios, first starting with our accounts receivable turnover. This is a measure of how efficiently a company collects its payments from its customers. So a higher turnover means more efficiency when collecting those payments. So throughout the period, both Thermo and Bio actually had pretty comparable turnovers. In the first couple of years, in 2019 and 2020, Thermo did have more efficiency in that turnover, but then from 2021 to present day, Bio had actually increased their efficiency and outperformed Thermo in those. But overall, it was both still had very efficient turnovers. Okay, and so then when we jump into average collection period, that's going to be talking about how long it takes a company to actually collect those payments, and that's in terms of days. So when we look at the most recent 5 years, Bio-Rad actually had a lower collection period than Thermo in all 5 of those years, which means that they were able to collect on those payments quicker and more efficiently than Thermo. But overall, ideally, you want to be able to make that collection within 90 days. Usually after 90 days, that's when it is harder to collect. So both of the companies did succeed in that regard. Okay, so then for your inventory turnover ratio, this is going to be how many times the company sells and replaces its inventory during a given period. So you actually want a higher turnover ratio, because that suggests that you are able to sell and restock efficiently. And so throughout the recent 5 years, Thermo actually had a significantly higher turnover ratio compared to its competitor, Bio-Rad. But it's interesting to note that, from 2019 to 2022, they were in 4+ range for that ratio, and then it took a significant drop from 2022 to 2023, which suggests that something was missing there and they were no longer as efficient in selling their inventory. during 2023, which does coincide with the fact that their revenue actually dropped 5% from 2022 to 2023. So then your average age of inventory, that's kind of goes right along with it, and so that's going to be how long it takes to sell the inventory and get rid of it. So here it's actually, because it's counted in days, you do want a lower average age, because that means the quicker you're able to sell that. So from 2019 to 2022, Thermo did have a significantly lower age than Bio, which suggests that they were selling their inventory a lot quicker, but also made that same jump from 2022 to 2023, where it was that big increase, and so they aren't selling as much of their inventory in 2023. Okay, and so then getting into inventory to net working capital, this is the proportion of the company's net working capital that is tied up in its inventory. So you actually want a lower ratio, which suggests that you have still excess funds to be able to do other things for the business. So throughout the 5 years, with the exception of 2020, we actually saw that the competitor Bio-Rad had a lower inventory to networking capital ratio than Thermo. But overall, both actually still had strong ratios, as ideally you want that ratio to be below 1, which means you still have an excess of funds or excess of capital to be used for growing the business and such. Okay, so your total asset turnover, this is going to be your company's ability to generate revenue from its assets. So throughout this observed period, Thermo had a higher asset turnover than its competitor Bio throughout all 5 years, but it's important to note that even though it is better than their competitor, their ratio wasn't particularly strong, as it is still less than 1. Okay, so then for our fixed asset turnover ratio, this is the measure of how efficiently a company generates sales from its fixed assets. So this can include like PP&E, your property, plant, and equipment. So we saw that up until 2020, Thermo actually did have a higher ratio compared to its competitor Bio, but then in 2021, Bio had an increase while simultaneously Thermo had a decrease. And since then until present, Bio has had a higher fixed asset turnover ratio, which suggests potentially that over the past 3 years that Bio has been potentially utilizing their fixed assets more efficiently compared to Thermo.
Financial leverage is an investment strategy of using borrowed money, specifically the use of various financial instruments or borrowed capital to increase the potential revenue of an investment. Starting with the company's fixed charge coverage, the FCC is an important indicator of a company's financial stability and ability to meet its debt obligations. As you can see, Thermo has higher ratios for this 5-year time frame from 2019 to 2023. Which signifies better financial wealth within their company, while Bio-Rad ratios for the past 2 years have been in the negatives, showing that they're in financial distress. Bio-Rad financial stability was stronger during the years of 2019 through 2020. Next, looking into the company's basic earning powers. Analyzing the company's BEP, investors and analysts can assess how efficiently the company is utilizing its assets to generate profit. A higher basic earning power ratio indicates that the company is generating more profit per dollar of assets, which signifies strong operational performance. This focuses solely on the relationship between operating income and total assets. As such, it provides a useful benchmark for comparing companies within the same industry or sector based on their operational efficiency. So comparing both companies with basic earning power, again we see that Thermo is doing well for their previous 5-year time frame, staying out of the negatives, which signifies strong operational performance for the company, and that they're generating enough revenue to cover its operating expenses and costs, resulting in profitability. As for Bio-Rad, we see that for the last 2 years, the company has been in the negatives, meaning that the company is not generating enough revenue to cover its operating expenses and costs. This indicates that the company is not profitable and may be experiencing financial difficulties. But during 2019 to 2022, their BEP was at its strongest, generating more revenue. 1. The company's debt ratio tells us how much a company relies on borrowed money to finance its operations compared to a total asset it owns. Life science companies often have high upfront costs for research and development of new drugs or technologies. They may rely on debt financing to fund these activities before they start generating profits, so they can have higher debt ratios. With both companies being in the same industry, any debt ratio over 2.5% will be considered high, but expected for a life science, healthcare, and laboratory equipment industry that's newer. Both companies have low debt ratios, letting us know that the companies is financed more by equity, owners' investments. This can be a sign of financial stability, but it may also limit the company's growth potential if it has difficulties accessing new capital. Next, comparing both companies' debt to equity. For these type of industries, a D&E over 2% would be considered high. Looking at Thermo Fisher's from 2019 to 2022, their D&E has been over 2%, which can indicate that the company has significant financial leverage and may be at risk if economic conditions worsen or if interest rates rise. As we can see in 2023, their D&E decreased, which could have been caused by several changes, such as the company increasing profitability, cutting costs, or improving work capital management. On the other hand, over a 5-year course, Bio-Rad has been able to keep their D&E low, under 1%, which can indicate that the company has less financial risk and may have more conservative financing strategies. For corporations operating in the life science, healthcare, and laboratory equipment industry, a high long-term debt-to-equity ratio may be common due to the significant capital investments required for research and development, acquisitions, and other growth initiatives. However, what is considered high or low can vary depending on the specific circumstances of each company and industry norms. Considering this industry, a long-term debt-to-equity ratio above 0.5% may be considered high for companies in this industry. Both companies have ratios above 0.5. Having a higher ratio may indicate that both companies have taken on more debt relative to their equity, which could potentially lead to financial instability in the future. To lower their long-term debt to equity, both companies would need to negotiate with creditors, issue equity, or refinance debt. Next, in this industry, a high time interest earned ratio would typically be considered anything above 3 or 4%. This indicates that the company generates enough operating income to comfortably cover its interest obligations. Reviewing both companies, you see that both companies have high time interest rates, meaning that both companies have a strong ability to cover their interest expenses with their earnings. This indicates that the company is financially stable and less likely to default on its debt obligations. For Bio-Rad in year 22 to 23, their time interest earned was in the negatives, meaning that the company's EBIT wasn't enough to cover its interest expenses, which can indicate financial distress or the inability to service debt obligations. This could suggest that the company may be facing challenges such as declining revenues, increasing costs, or high levels of debt.
Bio-Rad's higher gross profit margin compared to Thermo Fisher may indicate that Bio-Rad has better control over its production costs or is able to command higher prices for its products. Both companies have healthy net profit margins, indicating their ability to generate profit from their core business activities. Bio-Rad's slightly higher net profit margin suggests that it might be more efficient in managing its expenses compared to Thermo Fisher. Thermo Fisher's higher ROI indicates that it generates more earnings relative to its investment in assets compared to Bio-Rad. This could suggest that Thermo Fisher is utilizing its assets more efficiently to generate profits. Thermo Fisher's significantly higher return on stockholders' equity indicates that it is more effective at generating profit with the equity invested by shareholders compared to Bio-Rad. This could be due to Thermo Fisher's higher profitability and or better utilization of shareholders' equity in its operations. In summary, while both Thermo Fisher and Bio-Rad are profitable companies, Thermo Fisher generally outperforms Bio-Rad in terms of profitability ratios and return metrics. Thermo Fisher demonstrates higher efficiency in managing its costs, generating profits from its assets, and utilizing shareholders' equity to generate returns.
Hello, this is Miriam Darden. So on this slide, we have the market-based ratios for Thermo Fisher. Using the stock price from April 29, 2024 at 576.80 cents, we found that the price per earning ratio was at 37.33, the market to book value was 1.84, and the EBITDA was 754.08 cents, excuse me. Based on the information Thermo Fisher gave us for the 2022 year, there was an increase for the price per earnings from 31 to E37, making it known that the company has become more profitable. Adding that to the low market to books ratio as well as the high EBITDA, we inferred that the company is lowering their stock prices to possibly entice investors into profitable projects that the company is ensuing on. And this is because the market to book ratio is so low that in comparison, we indicated that the market price was well below the value of the average book price, as well as the high EBITDA, which indicates that investors are buying premium stock, which will probably only happen if they feel like the stock is profitable in some sort, which ties back to our price to earning ratio for this year. So on this page, we have the market-based ratios for Bio-Rad, and as you can see, it is a complete 180 to that of Thermo Fisher. Our initial assumptions about the company was that it was recovering from some sort of financial crisis. This will be a factor in the investors not finding the company profitable and therefore pulling their investments. The result being a negative price per earning and a negative EV and EBITDA. However, with the market to book ratio being as high as it is, with the average number being 1, it's highly likely that the company is trying to boost their funds by making their stocks more valuable than their actual book value, therefore increasing the profit margin. So due to Bio-Rad having no payouts during its lifespan, there's actually no data when it comes to its dividend payout. However, with Thermo Fisher, we see that the percentages have greatly decreased all the way down to 4.53 in 2001, before slowly increasing to 7.86 in 2003. In this case, higher numbers are not beneficial to the company because the ratio indicates how much the company's retained earnings is going to its shareholders. So while it's not as high as 11.87 from 2016, it's still something that the company should monitor. As stated previously, due to the fact there are no dividend payouts to be recorded due to Bio-Rad not doing dividend payouts, we also cannot provide any dividend yields because there was nothing to pay out. Moving on to Thermo Fisher, we were able to calculate a 0.27% a dividend yield ratio, meaning that for every $100 an investor puts in, they would roughly get about 25 cents out in dividends, which is good for the 2023 year that we base this off of. In the 2024 year, most recent dividends that have been released have been around the 30s, 36 and 37. So it's a great indicator that as well as pairing it with the price per earning and the EV and EBITDA, that Thermo Fisher is becoming a more profitable company and something that investors are more likely to buy stocks from.
Okay, so getting into accounting measures, first we have our total net operating capital. This is going to include your net operating working capital plus any long-term or fixed assets that the company has. Here, it's kind of interesting. You can actually really see the difference in the size of the two companies. Both had a little bit of fluctuations through this period. As you can see, Thermo, they actually reached a peak in 2020 at 13,300,000, and then took a pretty significant drop in the later years, in the next year, but they did actually reach back to that 13 million in 2023. And then talking about our net operating working capital, this is going to be the difference in our current assets and current liabilities. Both companies had a bit of fluctuation during this period, but Thermo consistently had a significantly higher net operating working capital compared to Bio-Rad. And this suggests that Thermo likely has more assets to be able to fund their day-to-day operations.
Gross investments in operating capital represents the amount of capital invested in a company's operating activities. With the exception of Bio-Rad in 2022, both companies' gross investments in operating capital was negative, which is not possible. This suggests that over the recent years, the companies have reduced or stopped investments in operating activities. Net operating profit after taxes represents a company's profit from its core operations after deducting taxes. Here you can see the drastic difference in the company's size and profits. Throughout the period, Thermo had a significantly higher net operating profit after taxes compared to Bio-Rad. This tells us that the company is running efficiently in their operations.
Okay, so free cash flow, this is going to be the cash that is generated by a company's operations after accounting for its capital expenditures and investments. Throughout the period, Bio actually had some fluctuations in their cash flow. Thermo actually had a pretty steady increase over the 5 years. And this is definitely another instance where you can see the size difference in the two companies. Thermo has substantially higher free cash flow compared to Bio, which definitely suggests to us that they have more cash generated even after accounting for those expenditures. Then operating cash flow, this is going to be cash generated by the company's core operating activities. And so both companies had quite a bit of fluctuation throughout the 5 years, but Thermo was still substantially higher in their cash flow compared to Bio, with the exception of the year 2020, where Thermo had a decrease and Bio had a nice increase. But it is important to note that obviously that was COVID. Times were definitely a little interesting. And so even after that, by 2021, there was a resurgence in Thermo and they were able to increase their operating cash flow back to 14 million. So overall, this difference definitely suggests that Thermo generates more cash from just their core operating activities. Okay, so return on invested capital. This is going to be a company's efficiency in generating returns from their investments in operations. Interesting enough, Bio-Rad actually had a significantly higher return compared to Thermo in the first few years until they took a very significant drop into 2022. So even though Bio's does exceed Thermo's by quite a bit, overall Thermo was at least able to show a lot more consistency in the returns over the 5-year period. And market value added, this is the difference between the market value of a company and the capital that is contributed by its investors. And this can indicate a company's capacity to be able to increase their shareholder value over time. So here we can see their MVA is significantly higher than Bio's, but relative to the size and ability of the companies, both actually do have a high market value added. So this suggests to us that there is evidence of effective management and strong operational capabilities within both companies.
Thermo Fisher's debt ratio and debt to equity ratio have fluctuated over the years. In recent years, the debt ratio appears to be decreasing, indicating potentially less reliance on debt financing. However, it's still relatively high compared to Bio-Rad's debt ratios. Thermo Fisher's ROE has shown variability over the years, but generally remain at healthy levels. This suggests that the company has been effectively utilizing its equity to generate profits, which could positively impact its cost of equity capital. Thermo Fisher's ROA has been relatively stable and at satisfactory levels, indicating efficient utilization of its assets to generate profits. This can influence the company's overall cost of capital. Thermo Fisher's fixed charge coverage ratio has generally remained healthy, indicating the company's ability to cover its fixed charges with its earnings before interest and taxes. A higher fixed charge coverage ratio typically implies lower financial risk and potentially lower cost of debt capital ratio. Thermo Fisher appears to have a mixed cost of capital profile. While its ROE and ROA indicate efficient use of equity and assets, respectively, its debt ratio suggests a significant reliance on debt financing. In summary, Thermo Fisher Scientific Inc. and TMO Inc. display strong financial